Okay, Cam, this is our second session. We're going to talk about a number of important factors, most significantly how to survive as an options trader, and maybe convert what we're doing from outright gambling to adult options trading. We're all seeing what's happening in Wall Street bets where guys are putting half their account in one position. They're either very successful in Tesla or playing against the market, or it's just another story of loss porn where they, lose their entire account. And we're going to discuss, what is the most important factor to long-term success and position sizing and, the best system to be long-term successful as an options trader. But I thought we'd start with, what's the most important factor to long-term success, and is option trading doing it this manner? Is it a viable alternative to owning and trading stocks?
Well, I think that the main issue is understanding that option trading is more speculative than it is investment. And so once you have your basis for investing in general, then I think that once you quantified what you can use as risk capital, all of a sudden that becomes a much more manageable situation, in that if you're only taking 10% or 15% of your investment money in moving it into options, you're already taking the best first step into not over trading. The biggest problem is people who over speculate, and that leads them down the road of, making it really difficult for them to be able to reasonably assess what their risk is and what their, realistic expectations are for gains.
We saw what happened last year. The impetus for this whole process years ago was we were getting frustrated because gurus and option trading people that put out, recommendations would show some of their best ideas that have made hundreds of percent, and the ones they lost money on, they would just sweep it under the rug. And we said, how about if we show every single recommendation, good and bad, and we'll just own up to our results. And we actually track what percentage of the time that we're successful. So we actually look at, and I'm just looking at our roster starting right in the beginning of this year, and that right now we've had some very good trades, and we've also had some difficult ones where we go basically into drawdown. And last year especially, we had a horrible period of drawdown. And can you explain how, first of all, over the last 20 years, what was your worst drawdown? How many successive trades? And how did you survive during that environment?
Well, the first thing related to that is, very simply put, it's not only that we're showing all the trades, it's also that we don't come to you and say, we did this, we did that. It may look that way in the weekly letter that we put out, but the fact of the matter is that's not how we operate. We send out an alert. This is what we want to do. If it gets filled, it gets filled. If it doesn't, it doesn't. I don't take credit for any trades that didn't take place because I had a good idea. The fact of the matter is we are 100% transparent, and we give the trades out as alerts, not after the execution, but before the execution, including both price and description of what we're going into.
We're going to talk in a minute, Cam, about how to maximize your success as an options trader, but how important is position sizing to long-term success in your opinion?
I think it's overwhelmingly important. In fact, I think it's the most important. I think that most brokers and money managers, I think that the allocation of money is actually more important than what individual stocks you trade. Once you have rules, it really doesn't matter as long as you're not over trading. I think that that's a pretty major problem for most people. They see an idea.
And last year, when you had a period where we had an extended drawdown, and we still ended the year very, very positively, what did you use to not get too frustrated, to stay in the game? Did you increase your sizes? Did you do revenge trading? What did you do?
No. In fact, last year, as what you had mentioned before, as far as drawdowns, last year was the first year in 7 years that we had a negative quarter. Going into the year, we got started, and by the beginning of May, we were up 37%. And then the tweeter-in-chief started acting up in the middle of the night, and it was very frustrating because I'd go to sleep with a trade that was nicely profitable and wake up to a gap down that took me out of that trade.
Right.
So we were up 37%.
I see here up about 37% around April 3rd.
May 1st.
Okay.
Right.
Okay. Yeah.
And then from the end of March through the end of July, we made 31 trades, 28 of which were losses.
Wow.
So that was very frustrating. You can see on the screen here the number of trades that were in the note column: 50% down roll, 50% rule, 50% rule. And so those are based on the rules, and we really didn't have any other way to do it. But what was important at that point in time was that I cut the position size the first time after the first bunch of losses. And then by the time we got to the end of May, I had cut position sizes in half. There are some big losses, but frankly, in a $10,000 account that was actually at $13,700 about, a $96 loss and a $168 loss and a $200 loss are not really overwhelming. Those are absolutely.
And you did the position sizing based on the original size of the account, not the fact that it had grown.
No, I never do that. I treat the account as if it's a $10,000 account. Right now, the account is only up about 13%. The fact of the matter is that even that close, I don't change it at all. It's always going to be the same starting position. If something works out, for example, the CVS trade that we just entered into, I bought a small position at $1.20, and it did exactly what I was expecting it to do, and I added to it. When I add to it, I only added 50% of the position size. So we started with 4, and we ended up with 6. And the point being that if you continue to adjust the account up for the equity that's in it, you're essentially kind of doubling down. And the one thing that I've learned in double or nothing is eventually it turns to nothing. And so I'm very specific.
Last year, basically, you started the year just like you start every year with an example, 10,000. The 10,000 is a base account. You can certainly trade 10, 20, 30, 50, 60, and just multiply it out. but 10,000 grew to about 13, 14,000, came all the way back down, and then we were able to get back to 16,000, which was about a 66%, 67% gain, while only being profitable 52% of the time. What percentage of the time do you need to be correct to be long-term profitable using correct position sizing, would you say?
Using the position sizing, you almost have to make an effort to do the wrong thing in order to not be profitable. If your rules work and if the process that you use to make the trades works, then you're going to be taking much more in the way of gains than you are. I'd like to switch over to the selection because I think that that's an important issue. I don't buy breakouts in stocks. I buy support. If you'll put up the CBS chart, I think it'll become much more evident what it is that I'm talking about.
So on a daily chart?
On a daily basis. Okay. So CBS, like everybody else, broke down starting in February and moved all the way down to this area around 52, 53. And we were constantly there. Now, I'm not going to go into all of the reasons that I did it, but I will show you. There are plenty of indicators here that I'm not going to discuss. What I'm going to show you is CBS, starting in the middle of March, created a base for itself of day after day, the low being no lower than whatever these bottoms are, 52 and a half. It came back up and started up. And in fact, I think I traded it in a small way in there. But the trade that interested me the most was entered into in this area around 53 and a half, 54. The reason for that was that I had a workable stop at those bottoms. And to go a step further, not only did I have the bottoms, but on the March 23rd, you have the lowest close. So I was keying off a close at whatever that number is. Let's see, can you pull that up? Yeah, okay, so we have 53.09 was the close. So I was in there buying it at 54, and I had a stop roughly $1 below. So that's an interesting way for me to do it. The difference is that if we bought it in here, if we bought it as it broke out on Friday above all of those tops, my point would be, where am I wrong? Well, I'm not really wrong until it closes back on that day that you just had highlighted, right around the 55 level. So here we are putting on a position at 60 or 60 and a half, that I'm not going to know that I'm wrong for $5.50. Where I put it on, I had a $1 risk, and the reward has worked out dramatically better. That is a risk-averse position. That's where.
But you were looking at the close on the low day, which was right here. 53.09. Basically, your risk.
Right, absolutely. If it would have closed below there, it would have been an issue. Now, the other thing about that is that the options that I bought would not have been down $1. They would have been down 20 or 30 cents. You know, when you can trade a $1.20 option and have a 25-cent risk in it, and you know that you're wrong, that is definitely much more of a controlled trade then, for example, I wrote against these. I'll discuss that at another time. But if I were going into it here on the breakout, I probably would have been buying the 60s, and the 60s are $1.80 or $1.85 yesterday. So if I have a $5 risk on this, those options, which expire next Friday, I would have had, essentially 100% risk. I wouldn't have let it go that way with our 50% down rule, but in theory, I took a 25-cent risk on $1.20 as opposed to taking a 95-cent risk on $1.80.
Now, some people would say, we could draw right here, the support and resistance if you took the position here. You think that this would be a riskier trade than taking it right around, where we did it before?
Well, definitely where I got it before, but the risk in the trade up here would be down to these closes just over 55, and that's $5. That's 8%. My risk of $1 on $52 or $53, where I was getting in, is less than half that. It's a 3.5% to 4% risk.
Right.
And at least by then, I'd know I was wrong. In this second setup, where we buy it when the stock is 60.5, we're really talking about it could have gone back down to that 55.5 and still be a long.
I get a lot of questions. I get a lot of questions that, is there a system? Do you have a system, or is it simply finding, low risk entries that are working on your reversion approach, as opposed to, you're not really buying breakouts or breakdowns. You prefer something that's stretched with the Bollinger Band, stretched away with unbalanced volume temporarily, that ultimately will work with a reversion, where you'll buy it here, it will travel up, and then maybe if it goes up a little bit too fast, then you might convert it to a spread, sell some calls against it, a covered call right, a poor man's covered call right, if you would.
Okay, and in this particular trade, just to give you the numbers so that it's really clear, we paid a combined price between the first position and the 50% add-on of $1.37. When I saw the stock perk up and I saw it trading in an area that I thought might have some resistance, I sold half of it. It wasn't the 100% up rule, sell half, take your money off. It was just a sell. I have rules, but the fact is there are other methods other than the protection of 100% up and having your money, or the protection of a 50% down and selling the position out.
Why did you put those rules in place? I know for the last 10 years or so I've been watching you trade. Why are you so adamant of selling half at 100% profit and getting out at a 50% loss no matter what? Because I saw this week, I thought that the market looks a little dicey, and I was looking for this to come in a little bit, and you had bought some basically puts on the market by using the calls on SPXU, but they went down, you followed your rules, and you got out, where a lot of people would give it some more time, and they would have ended up losing money on it, but you followed your rules, and you didn't deviate. When did you develop these rules, and how did that come about?
Well, it's just really been a numbers game. You make enough trades, and if you're interested enough in your trading to see, over an extended period of time, where you had your biggest losses, where you had your biggest gains. It's kind of a historical thing, but that SPXU is an interesting trade because I didn't wait for the 50% rule. I realized I was wrong, and instead of using a stop at just under 80 cents, which probably would have netted us 70 or 75 cents for those calls that I had
Right.
bought. Instead, I put the order in and sold them at 96. The fact is, we saved about 25 cents. So we lost money, but we would have lost probably 30% more. And so we were out.
Right. What did you get in? About $1.25?
Yeah.
Okay.
I think $1.55. So we
Okay.
would have had to stop at 73 cents or 70 cents. Ultimately, within a couple of hours of selling those, they were 40 cents.
Yes.
So we definitely would have been out.
Yeah, they're
I
50
used
cents
my
now. I
judgment.
see that.
Yeah, I used my judgment and I just got out. But I want to go back to the CVS trade because I think that that's important. So we had $1.37 cost, and excuse me, I sold the first half at $2.15. What that did was it reduced our cost on the second half to 59 cents. So in order for us to lose money, they would have had to go all the way down to 59 cents. What I did as a tactic, and I'll get back to this, was I wrote the 60 calls against it. They expire the same day as the 57 and a halves. I did it a little early. Ultimately, they went substantially higher. But I was looking at that $61 area. If you look at the middle to the beginning of March, you'll see all those closes, a little further to the right, you'll see all of those closes before the breakdown, a little further to the left, about 10 days.
Okay.
You'll see that there are a bunch of closes in the $61 area. So I figured 60, 61. Well, I wrote the calls at 60 cents so that I could get essentially 61 for the stock.
Yeah.
60 for the loss of the stock and $1 they paid us for. So now the position that we're in is really quite remarkable. We own a $2.50 spread, which is worth 2.5 points. So that's $250. It costs us literally nothing. They're paying us 41 cents to be in that spread. We have a cost of 59. I wrote the options at $1. So that leaves us with a 41 cent credit. As long as CVS closes 60 or above, we will make $2.91 a share on
You're
that
thinking
spread.
this environment with the implied volatility higher, that you're going to be doing more of that kind of thing?
Well, I don't generally trade spreads as a rule, but in this case, yeah, I think that, the stock was 59 and change when I wrote the 60s. The 60s right now, I don't remember what the close on the stock was, but the 60s right now are worth, nope, those are the April 20th. We're in the April 17s, yeah.
Okay, I'm sorry. Hold on.
Okay.
1 second.
Okay.
So those are the ones you have, and you're in the 60s.
Right. We're short the 60s. So essentially, the stock is in after hours traded up to 61, but those options are selling for somewhere in what was the bid and ask
156 by 219, and it's after the close right now anyway.
Right. And so the fact of the matter is, they're basically they closed. I guess it looks like 249 is where they closed on. No, okay, 219 in that area. They're worth $1. They expire in 5 trading days. That's actually kind of a lot for something like that. When I wrote them at $1, they were $1 out of the money, and so they were worth even less. So I saw the opportunity because of the implied volatility, and we're just out. So so the close here in the real world was 60.47. Those 60s are worth 47 cents, and my recollection is they closed around $1.85.
Correct.
So that is really overpriced, considering the stock has just had a 7-point run or a 6-point run to the upside. The market has had an unbelievable run, much more than I would have expected, and I think that probably we're going to have a little bit of a sell-off. So I sold something.
Talk about when it's not going well and you're buying spider calls and puts, how you switch to stocks, etc. If it's not working here, you don't have revenge trading where you have to make it back in the same vehicle you lost.
Yeah, that's not an issue for me at all. When the indexes are having the kind of swings that they are, the volatility is incredibly high. And the velocity of the moves is pretty incredible. If I'm doing poorly trading the indexes, I immediately go back to the simpler stocks that are not driven by the indexing people or the algorithm people. You just don't get the kind of rampant speculation in a CVS or really any individual stock, unless you're talking about, a Tesla or Netflix or, any of the big name popular stocks that drove this market as high as it's gone. And so it's easy for me to do my homework on the company. I absolutely favor, from the fundamental side, I favor CBS. I think it's a very interesting company.
Now,
but more importantly than...
Do you pay attention to the IVs and the historical implied volatilities at all?
Well, I do in my own way. I could tell you what any given option is probably worth experientially, having traded on the floor, having traded options for as many years as I've traded them. I don't really look at the numbers. I could pull up the, if I'm trading and I pull up the S&P and I see what the values are, what the prices actually are, and theoretical values for them, I can see pretty much that, implied volatility is higher than I would expect. In the stocks, it just doesn't happen that way because the stocks have their own story. CBS is not a FANG stock, Facebook and Apple, Google kind of stock. It's actually a little bit more defensive. They're a pharmacy. They're a drug management, prescription management company. They own Aetna as an insurance company. You just don't get the kind of volatility that you have to pay for in trading a CBS versus trading an S&P, a SPY, or a QQQ, the NASDAQ hundreds, or any of those things. And so, if I'm doing really well, for example, that SPXU trade, that was actually, from my perspective, a balanced trade. That was, it was down near the lows, and I thought it could bounce back up because the market would come in. So I know that it's somewhat confusing to use a call to take advantage of a decline, but these are inverse ETFs. So in order to kind of protect myself, and I think this is an important item, in order to protect the gain that I had in CVS, I went looking for something that wouldn't really affect CVS, but would affect the market. And so it was kind of like trading on cash flow. Well, I was up, $250 from the first half of the CBS trade. So I could take a little bit of a risk to ensure that if the market turned down, I was taking advantage of that while not getting rid of the CBS. So, I think one of the other issues is balancing your portfolio, but that's more portfolio theory. In point of fact, the bottom line is still, if you can't make it in the indexes and they're very volatile, I think, you either cut your size of positions if you're going to trade them, or you go back to the more reliable. A $10,000
account, to be an adult, I mean, if you're going to do it and you're going to go crazy, you're going to put $5,000 in a couple positions and hold thumbs. But if you want to survive, what's the most that you feel comfortable risking on each position?
4 to 5%, or 5. Let's just call it 5%. Sometimes a little more, sometimes a little less. But
so in reality,
5%,
with a 50% stop loss, that's 2.5%.
Correct.
Okay, and that's what we're basically seeing. Yeah.
Right, and that is in fact what we're doing here. Although, to give you an idea of what having your money out lets you do, if you look up and down that entire column, you'll only see one really large gain and one really large loss, and that was a gold spread where we made 1,040 and we lost 958. That was a two-sided trade. But if you look at the rest, you'll see, if you scroll up, you'll see that very rarely are our profits or gains particularly big. We have a $640 gain on the SMH, which is the semiconductors, which was part of the blow off at the top. We just happened to catch it right, and that trade literally took from a Friday to a Monday. But I want to get back to the CVS. We have most of our money off the table on the execution. The current value of that gain as of the close on Friday was $291 per spread times 3. That's a $900 gain. The reason that we have that $900 unrealized gain right now is because we bought it near support, we limited our risk, we took some off the table to further reduce our risk, and now, if it sits right where it is between now and Friday, we'll have an additional $870 gain on that trade. And in looking at that ledger, you see $900 gains. That's 9% of the value of a portfolio.
Right.
That's a darn good gain.
Yes, yes. So let's just sum this up. To be an adult as far as option trading, we have to have position sizing where our risk is no more than, after we take a loss, it represents 2.5% of the money that we're managing. There's no system. It's just very good entries with as little risk as possible. The most important thing is, again, position sizing to survive in this kind of high implied volatility environment. It's helpful when you get a gain to turn it into a spread, to sell some premium. You have to wait for and have patience to wait for some decent profits. You can't make a scratch of money and then immediately get off and get out of the position. To weather drawdowns, you might have to reduce position sizing and then sometimes switch from what's not working to what's working, going from indexes to individual stocks, and avoid revenge trading. If you lose money on CBS, doesn't mean you have to play CBS again and then again to try and make the money back. You could switch from blackjack to craps if necessary.
Correct.
I missed anything?
Nope, I don't think so. I think that pretty well sums it up. It also doesn't hurt. As I said before, it's kind of a numbers game. Over this long 3-day weekend, I will probably look at between 500 and 700 charts
Right.
of individual stocks to find another CVS.
Things
Find,
that
you
are
know,
healthy,
whatever it is.
that are stretched, too little, too much volume, stretched, touching their Bollinger Bands near support that you think are going to revert to another direction, so to speak.
Yeah, and there's one other item I might add, and that is, it's a very old saying, and it's still around because it means something, and that is, you know, you look at the trend and you trade the market that you have. You don't theorize about the market that you want. You trade the market you have, not the one you want.
Right, and we'll leave it at that. Cam, thank you so much. And we hope to do more of these in the future as we develop, other questions people might have. But again,
Great.
Thank you so much. We'll talk soon.